Good morning. We do these every fortnight. This is the every alternate fortnight. We do one of these portfolio mindset meets mechanics portfolio considerations, real world portfolios webinar, which means we do this every month. And today is going to be a little bit of a slightly different emphasis. Dave will join me in a few minutes while I just go through setting the scene. And then when we get into the Learn to Trade Properly study group portfolios, he'll join me, and we're going to do that mostly in slides today because there are a few points we want to make, and we're also going to have a look at some feedback that we've got from somebody who has done one of these sessions, and we're going to just really ask some questions of you and ourselves as well and see if we can answer them. So we'll go through those Learn to Trade Properly public portfolios because they are our customers, you trading your own real money with those and hopefully learning. And we'll have a look at a couple of mechanical trades enduring volatility. And as per some feedback we've had, we're just going to look a little bit more at the indicator, the main indicators used in SPA3 Investor, and talk a little bit about mechanical trading and some of the rules in there. So let's get into it. Before I do that, to tell you that everything we cover here today is general investment advice and not personal or specific investment advice, and that past performance is no true indication of future performance. Today's quote, one from Arnie: "Strength does not come from winning. Your struggles develop your strengths. When you go through hardships and decide not to surrender, that is strength." So, and that is really what I use that quote because that's effectively what and that's Arnie's talking about physical strengths there. We are talking about mental strengths. And it's the same thing because effectively to get through, to grow physical strength, you have to have mental strength too. You have to get comfortable with being uncomfortable. And really that's what the skills acquisition plan and the Learn to Trade Properly study groups is all about, is that we've got to go through some struggle. What's the struggle? The struggle is enduring at least a 10% drawdown a couple of times in the Learn to Trade Properly portfolios that you run, because that is guaranteed to happen in any portfolio that anybody has, is, or will be running in the history of investing, to get through those drawdown periods, to get through that struggle. And that's how you get the mental strength. And we're going to have a look at an example of somebody today who has not developed that mental strength of getting through a 10% drawdown. So what happens when you don't? Well, you give up. That's what you do. You give up. You stop, either temporarily or forever. Why? Because you don't ever get to develop that strength to reap the benefits of staying in the flow and getting the benefits, the eternal, ongoing, forever opportunity stream that flows from the markets. So we're going to look at real world portfolios. We're going to look at the SPA3 Investor US and ASX public portfolio and the leveraged portfolio. Not too much on the leveraged portfolio today. It's going along well, but that's not the reason. It's just because of a time factor to fit in some of the other things that we're going to be talking about today. Be back certainly, excuse me, in the next real world portfolios. We'll get into a bit more detail in the leveraged portfolio. Objectives of this session is to look at all the ups and downs, ins and outs, warts and all, good and bad, that goes along with investing, active investing, trading in real world conditions, and to cover all of timing, money management, risk management, and all the slush balls that trading in the real world throws at us. And really what it's all about in any environment that you want to develop skills, that you want to get better at, that you want to develop, that you want to improve at, is that you've got to learn to be able to execute under pressure. And because we can all do that theoretically, we can all be aware and know, but to actually do under pressure, well, that's a whole different game. And that's what these sessions are all about, to get to the heart of that. So let's have a look at and we'll also look at the Learn to Trade Properly study groups. The real world portfolios that we're doing there's one started on the 20th of September, one started in the US on the 9th of December, and then an ASX on the 3rd of February and a US on the 3rd of February. And we're going to look at these because particularly these last two are in a bit of drawdown, not quite the 10% yet, but heading there, whereas the others are okay. So what environment are we looking at here that we are investing in? Although we're looking at September in the learn to trade properly portfolios from September last year, but in the real money public portfolios, we go back all the way to 2016. So here we're just looking at what the markets have done since July 2021. So and to see how the American market's done. Well, the American market over that period of time is up 18.5%, 0.3%, and I'm taking it from the high that was made back here in January of 2022 to current. And this is 1 day out, so it's down a little bit more in today's US session. And so that's what the US market's done, whereas the Australian market up to yesterday's close is only up 2.5%. So obviously what that's setting the scene for is saying US portfolios should have done a little bit better over recent times. And they have, and so is the public portfolio. And I keep reminding you that this is a discomfort zone that ran from August 2021 to here, which was August of 2024. But hey, look, we've had this retracement on the ASX, which has just about put us all the way back to that retracement zone. So you could, if it did fall a little bit more and got down to this point, or to the point that it got to over here, which is 7897, then that 7897 back here would mean that we've actually been in a sideways moving market for over 3.5 years. So let's keep an eye on that. So that gives us an idea of the environment. So let's look at the ASX relative portfolio performance here. I'm going back to August of last year, looking to see how the public portfolio, the real money public portfolio, has done. It's up, what is that, 17.1% since the 5th of August. And whereas the accumulation index is up 5.7%. So there's some outperformance in this environment. Sure, there's drawdown here. And the All Ords without, the ASX200 without any dividends is up just 2.9%. So some outperformance in this period of time. And why am I doing this? Well, it's I often point out, and we're going to be doing that now in the other portfolios, the drawdowns. We keep on making a big noise about drawdowns. You're going to experience drawdowns. It's going to be tough. You're going to have to get through it. It's discomfort zones. But we should also point out the flip side as well, that, hey, there are times where the edge does outperform and is ahead of the market. And sure, it's in drawdown, but it's in less drawdown than the market. And over time, of course, what active investment or trading in the markets is all about is it's an infinite game. It's about keeping on playing the game. The objective of the game is to keep playing the game and to work out how to do that both analytically and mentally so that you outperform the index. And that's what we're doing. And what does that mean? It's not just, an edge isn't just about making a profit, i.e. getting greater than zero. It's really about making a profit that's better than if you had really just left your money in an index ETF and left it there, or in a balanced fund or any of the alternatives. So you get some payback for the active that you're doing relative to if you were just 100% passive. Right, looking at since inception, going back to 1 January 2016, this is compared to the ASX200 Accumulation Index, 179.2% compared to 114.9% over that time. And I think that works out at about 3.5 compounded percentage points better than what the ASX200 Accumulation Index has achieved over that 9.2 years. And remember that the majority, I think now the SPIVA scorecard information is getting longer and longer on the ASX equity funds and in balanced funds, or balanced funds will do slightly worse than equity funds over the long term. Is that equity funds, I think it's now 85% of equity funds underperform the ASX200 Accumulation Index over periods of 10 years or longer. In the US, it's worse than that. I think it's 93% of equity funds, which obviously outperform balanced funds and target date funds. 93% of them underperform the S&P 500 Total Return Index. So if you are getting total return or accumulation index type returns, which is really buying and holding an index ETF, less a little bit of cost, and heaven forbid that you're not buying and holding and reinvesting in index ETFs through an advisor, where they'd be taking a clip of anything between 0.3 to 1.5% over the top, when you could just do that yourself. Then obviously your performance would be worse, and buying and holding an index ETF through an advisor of some sort would effectively take you back to investing directly into a balanced fund all on your own. So pointless investing in index ETF through an advisor, really is. So we're outperforming. That's the point I'm making over here, and this is over a large sample. Are you going to outperform every day, every week, every month, every quarter, every 6 months, every year? No, you're not. And that's not what is possible. Nobody can do that. But we are going to, over the long term, achieve. That's what we're all about. And I've got to use this opportunity to hone that in, because we get feedback to the contrary from members who do the training and still don't get it, which we'll talk about in a moment. So I'll take this opportunity to do that. Let's go to US relative portfolio performance. Since June last year, the US public portfolio is up 24.2% compared to the S&P 500 Total Return Index being up just 4% over that time. So some volatility in there, but we are getting outperformance. And if we go back to September 2022, there was a drawdown period that both ASX and US ran towards around about the third quarter of 2022, but outperformance of the S&P 500 Total Return Index there for now 2.5 years. And it's decent outperformance. Okay, US over the entire period that we've been trading this public portfolio with real money, there is about 0.8% annualized return underperformance of the S&P 500 Total Return Index, and and we look forward to outperforming and getting ahead. And now, when would that happen? Probably during the next secular bear market is when that would happen, but hopefully before then. And but we are keeping track with that total return index over the long term. So there definitely is an edge there. What is an edge? Well, an edge is being profitable, less costs. This is way more profitable, less costs. When we know now, all the stats coming in from around the world is that somewhere between 70 to 90% of active investors / traders and all kinds of instruments and markets lose money. They don't even make money. They lose money, let alone get close to matching the total return index. Right, here is the leveraged portfolio. This is the only bit that I'm going to cover on it. It's had drawdown. The drawdown is running at 14% at the moment on this latest drawdown period. It's had drawdown periods of 29%, I think is the maximum, 24, 29. And it is over this 2.5 year period running at 323% total return, and compared to the total return index of 61.3%. So that's the relative performance over the last 2 years of that. Right, now I'm going to get into sells over the last month in both the US and ASX portfolios, and then we're going to focus on the LTTP portfolios and make some points from that, because that's recent, and we know what there are many tens of members who are trading these portfolios are feeling at the moment. Dave is going to come in and join me with this section. Right, so looking at sells over the last month, let's get into the picture here. There we go. Over the sells over the last month in the ASX, there's been a few. So you can see I've taken the last session was the 19th of February. So we've had 1, 2, 3, 4, 5, 6, 7, 8 closed trades, which is indicative of what would happen when the market turns over a bit. Lots of green there. One stumble, and we're calling stumbles any loss that's greater than 10%. Was ARB Corporation, but the rest we got profits, and so a lot of people get disappointed when to various degrees, and the less you get disappointed when there's drawdown or when the market turns over and has a retracement, the more the stronger your mental capacity is to handle drawdowns. But yeah, let's put a positive slant on it. You get to take profits. You get to close out unrealized profits and let the market reset again. Because we hear it all the time when we get these long runs and the open trade profit in Portfolio Manager gets bigger and bigger and bigger and bigger. People get this urge to want to take profit because they don't want to give it back to the market. Well, here we go. So you can't have it both ways. You can't get upset about having open trade profits or feeling nervous, if you like, about it, and then because the only way you're going to realize those profits is for the market to retrace and get exit signals.
Exactly. And Gary, just to point out here in this particular example, what difference is there in the process that you followed to get the green on the screen as opposed to the red?
No, exactly the same process.
No, exactly the same process, isn't it?
Yeah.
Okay. So it's interesting, if you think about this, how people might perceive the red as opposed to the green, and this is back to Kahneman, et cetera, isn't it? How we put, so much more emphasis on a loss of $20 as opposed to finding $20.
Good point, Dave. So effectively what we're saying over here is that minus 12 is the way we feel it. It's actually minus 25%. And we just take these as they are. So let's take that up to minus 25%. There's 1, 2, 3 trades that are better, but in fact they're all better. But that's what we do, and that's one of the things that we've and this is the point that we're going to make later. We'll make it here now because it's come to me is that people will look at that and they'll try and solve not having another 12% loss, rather than accept that probabilistically out of what you see there is a good thing.
Yeah.
And then what they will do is they'll think they can improve the minus 12% loss. And whatever the threshold is for you, it might not be minus 12, it might be less, it might be more. But in so doing, they will also go and change all of these green numbers. And in my research, having been researching mechanical systems now for this year, 30 years, is that when you try and improve the minus, you make the positive worse as well. And that is what, so what is an identifiable edge? An identifiable edge is one where you look at the expectancy over a large sample, and the formula for expectancy tells you whether you have an edge or not. And then that's how you measure it without going and looking at individuals and focusing too much on individual profits.
Trying to analyze all that away, the law of unintended consequences, isn't it?
Correct. And you can look that up and go and philosophically find out what happens with trying to the law of unintended consequences. US, we've had 6 closed trades, 2 lost trades, 1 big juicy one, and a couple of one other really good one. And so there's some losses in there, but we've locked in some profits. And over this period, certainly where these losses are coming, the public portfolios outperform the total return.
And look at that hold days as well.
Good point. That's why I put them there.
506 days we've had to do absolutely nothing and not worry about it. And yet some people during that particular time, depending on their state of mind, would have thought, should I take some profit here? Should I get out here or what? It might retrace, it might do this if, ifs and buts all along the way. And this is where I think having the appropriate mindset to just understand the process, understand the edge, how an edge manifests itself, is, that can be quite challenging. And I think a big problem or a big challenge for a lot of investors is that if they go through a period of drawdown and then they see a bit of green on the screen, the huge temptation for them to go, I better take that before it disappears. The fear of missing out, etc. Really, it's that primal thought that we're trying to coach away and de-energize to remain objective and remain in the flow, and not put a big stick in the middle of the mechanism. Which is the edge at the end of the day. And I think that's really important to, that trade there, 506 days, requires a high level of skill.
Good, because people focus on, when they talk about timing the market, you focus on buying and selling. But every time you decide not to sell is also a timing decision, right? So every day that you've held that and you decided not to sell, which is very easy to do with the mechanical system. You just look and see where the price is relative to the trailing stop and you say, no, I'm not going to sell. But for a subjective technical analysis, I won't call it a system, call it a process, because probably is of some sort, is that every single day people will play. And listen, I've been there, I've done this, and I've tried it from time to time. Every now and then I talk to people who do this, is they will spend minutes, maybe hours, looking at each open trade, doing analysis to try and work out whether they should hold or sell. And whereas when you're mechanical, it's literally a second, 1 second to decide. But that is a decision, right? And those of you who've got it and wonder why we carry on like pork chops about this is because we still got lots of customers who don't get it, right? And they still go and they will go and use other analyses. They'll go and for me, the definition of analysis is also going and reading newsletters and looking at the newspaper to find out if any of that information they get there could affect a stock position that they currently have open. That's all analysis, all of it, right? You don't need to do any of that. You don't need to listen to the news as a typo. It should be spelled NOISE, not NEWS. But that 506 days, every single day was a decision not to sell. That is a timing decision that you make. Yeah. So, and the other thing that just when I was thinking when you're saying that, Dave, is that people think analysis is just technical analysis or fundamental analysis or both or whatever, and they put so much importance on that and trying to solve their trading problems, and they spend hardly any time analyzing an edge, what an edge is, how to calculate whether you have an edge or not, whether you have an identifiable advantage in your favor. Which is way easier to do because that is just a single formula. It's a mechanical, hard-nosed formula, corrected 2 decimal places, whether you have an edge or not and how good it is, which is the formula for expectancy. And then that's your analysis. Done. I have an edge, go and trade it, right? Whereas I just can't, I can no longer perceive in my mind what it would be like to trade subjectively with a whole bunch of technical indicators and chopping and changing them and trying to make up, trying to work out every day whether I should buy, hold, or sell. I mean, I just cannot perceive it anymore.
Yeah, well,
it's
Gary,
been such a long time.
I can give everybody a picture of what it's like to be in that sea of uncertainty because we've all been through it. All right, at some point in our trading careers, we've been looking for the holy grail and we've invested in lots and lots of resources until the point comes we realize, look, all I need to do is find an edge. How is, be in the state where we can create an edge, have the confidence, the capabilities, the technical prowess to be able to do that, and then develop the mindset to be able to then execute accordingly. Now, Gary, I'm going to put you on the spot. I'm going to ask you a question. Sitting behind us is a bookshelf full of books.
Yeah.
When was the last time you bought a trading book?
Wow, that's a good question. It's a good indication of probably where my head is. I used to I used to work in the city, and every time I was down the end of Collins Street where the ASX used to be, I used to pop into the ASX bookshop.
Yeah.
And then it became the Educated Investor, which Janine Murdoch ran, and she had a bookshop, and then she took it online. I would have spent thousands of dollars buying books, and every time I went past there, I couldn't help myself. I'd buy something, and I'd buy a book, and what were those books on?
Oh, it would have been probably on technical analysis,
Absolutely.
how to trade better, just all those sorts of things, a manual on how to do it.
But 95% of them were on analysis techniques. And just go and look at what's his name, DeMarco. His stuff is so technical. I mean, it really is. Wells Wilder, so technical. And I spent hours, weeks of my life poring over these. And what was I trying to do? I was trying to analyze away losing. That's what I was trying to do. So when we talk about it, I know I lived it for 15 years with my brain being so left-brained and analytical and maths and computer science and everything. I found comfort in doing that. It made me feel good. It made me feel like I was making progress to work out a better analysis method. And really, for so long, I had an edge, but my brain was so tuned into. Now, when I look back and having spent so much time with Mark Douglas, what my subconscious was trying to do was find perfection. It was trying to find a way to not have losses, and to find a way to not, and it was a challenge. And I thought I could solve this bloody thing, which you can't, right? And but I thought I could subconsciously. And I probably wasted, I don't know, looking back now, 10 of those. If I'd known, 15 years later, from when I started, if somebody had said to me, hey, 5 years in, stop that rubbish. This is what you got to do. You got an edge, just go and bloody trade the thing, right? And work out what you got to do mentally, and set up your trading, whatever it is, your lifestyle. Just go trade it, because you have an edge. I would have been, 10 years ahead of the curve at least, right? Yeah.
And
good question.
And that's the sort of thing, isn't it, that we're really trying to bring forward through some of the resources that we provide, is that realization that better analysis or more analysis doesn't make for better outcomes, because unless you know and can quantify how your analysis is going to work, and it's binary and it's not subjective, it's 100% mechanical, then you're always going to be in that sea of uncertainty. And
Correct.
You're never going to have that realization that you had to be able to say, right, I've got to stop doing this. I've got to think about this from a very rational, logical frame of mind, and have some good mentoring along the way that's going to help you, draw a line in the sand and start creating those essential habits that are going to make the difference ultimately. And, we talk about this in Learn to Trade properly, the importance of having an edge, understanding how an edge manifests itself, and we can talk a little bit about that. And really understanding that your job, once you have an edge and you understand how it works, is to, over a period of time, slowly, progressively develop faith and confidence in the edge. So we provide a lot of material around that. But there's nothing like having skin in the game, being patient, walking that slack wire, an inch from the ground, so that our mindset, our mental skills develop to such a point that, okay, I've got confidence now. I can now hang on to a trade for 506 days without wanting to take profit. I can hang on to a trade for 48 days and experience a loss, all knowing that it's part of an edge of the system. Absolutely. And if we can do that for our members, then that's going to help them develop, faith and confidence and become much better investors. Because at the end of the day, if they don't have an edge to start with, they're going to be in that sea of uncertainty. And even with the best of mindsets, they're still going to struggle. Correct.
And we'll get into a bit more of the edge itself and the trades and the analysis that goes into the edge in a moment. One other point I want to make here is that if you can't trade this edge, the Sparta investor edge, which is long and slow, I'll put to you that you'll never be able to trade any edge, because a lot of people want to go and trade faster edges, more volatile edges, faster profit edges, all that sort of stuff. And if you can't do it slowly, you will not be able to do it quickly. Correct. Impossible, because sure, the analytics will be there, because every single edge has losses. Every single edge has losses. And if you can't handle those losses, that it's not an analytical problem, because the analytics that you're looking at for all edges, provided there's an edge that you can see through historical and research and back testing, you must be able to trade it, but every single one will have losses. And so if you can't trade this edge, I don't know which edge you would be able to trade. I'll put you none. Okay, US leverage. There's been a few more sells here. There's some bigger, there's trades here. The ones that are in, so I'm just trying to get the mouse back. The ones that are shown here in the red rectangles are trades that are done in the leveraged portfolio that were not done in the unleveraged portfolio. So there are a couple of United Airlines came up, and there's one that we're going to look at in a moment, which is not in either of these portfolios. GILD, Gilead Sciences, which is probably having the best trade of its for a long time. But you'll look at that analytically in a moment and just pull apart the indicator to talk a bit about it. Right, sells over the last month in the Learn to Trade Properly portfolio. We'll look at the ASX one first. So there's one ARB, which came up earlier, which is I would call that a stumble because it's greater than 10%, but there's some leaps here as well. We'd say anything over 25% is a leap.
Yeah. And again, interesting. You're looking at those hold days, and there's a couple of trades there that have closed, but members had to stay with those trades for 125 days, following exactly the same process and not thinking about it. And the thing that's been really quite impressive about the members' behaviour in this is just opening themselves up and really, filling their minds with the right sort of mental thoughts, and that have enabled them to, remain the flow, think about the edge, become the casino, and realise that when they go through and that they're going to have lost trades, and being able to accept it, and the size of those wins and losses in in that big sample size is random in the short term. And so from that point of view, we're going to have some outliers.
Correct.
We're going to have some outliers on both ends of the spectrum, aren't we? So
Absolutely.
and when you think about that and put it in context, then all of a sudden people take a deep breath and they relax and they go, this is just part of the journey, Gary.
It is. And the sample, the presence of an edge is telling us that, those lost trades are going to be 2.5 times smaller than the profit trades over a large sample. And you'll find that with, the outliers as well. The outliers, actually, the profit trades are, take a bunch that you define as outliers, saying bigger than 100% or something, and the losses being anything less than 10%. Is that that factor, that payoff ratio of outliers that would be bigger than 2.5%, to be in the order of 4 to 5 times, your outliers on the profit side versus the outliers on the loss side. So this is the US portfolio now. It's had these are the losses that it's had. This is the 9th of December one. So the first one, the ASX one, has been going 6 months now.
That's right.
And this is about 4 months.
Yeah, that's right. So this particular portfolio has, when we talk about our skills acquisition plan, which at the heartbeat of learn to trade properly, and we think about, this concept of drawdown and being able to navigate our way through drawdown, driving through the sleet and the rain and the snow and getting to our destination. We haven't had much time where we've had the top down driving along in the sun at this particular point in time. So we've gone into, almost skills test mode right from the word go, because, there's a skill, as I mentioned before, there's a skill in holding on to a trade, but there's also a skill in closing those trades when the time comes, and, not making those errors that, I'll just hang on to this and see what happens, and letting small losses become big losses. So that's just an important skill as, letting those trades run. So again, we don't know the order of wins and losses for these variables that define our edge.
Fundamental rule number 3. There's a random distribution for wins and losses for any given set of variables that define an edge.
Yeah.
So there are 3 stumbles there, and so one of the objectives or the main objective of the Learn to Trade Properly is that we go through 2 periods of 10% drawdown, and you don't know what order that's going to happen. And the ASX portfolio started in September, had some run up to start with, and now it's coming into drawdown. It hasn't quite got. We'll see in a moment what the percentage drawdown is. So those are the cells there. The February one, okay, so this started literally 5-6 weeks ago. And this is the Australian one. So it's go ahead, I think it's 6, we'll have a look in a moment, but 5 of the 6 trades are being lost trades. It's got 1 open profit trade at the moment, which could still end up being a lost trade. But 3 stumbles there straight into drawdown from the get-go. Right? And so that's the equity curve. The gray equity curve there is in 6 weeks is the portfolio, the LTTP portfolio, and the red one is the ASX200 accumulation index. So slight outperformance.
Well, at the moment it is, and when we look at those red lines, and again, we don't want to make too much of this because the history is just so short, isn't it? But what we think is happening in our portfolios and the experiences that we're going through, well, the same thing is happening in the broader market as well. And that, when we think about that red line, that red line doesn't have any stop losses in it.
No.
So whatever happens to it happens to it. And that's the danger of using buy and hold types of methodologies, and particularly when we talk about it, we frame this, Gary, about stage 2 and stage 3 is really important, and we think about longevity risk and all those sorts of things. Having your a large amount of your capital tied up in the market without a handbrake on it would be very worrying. I wouldn't be comfortable driving a car if I didn't think the brakes weren't going to work. And so it's a similar sort of concept. So we need to understand that and maintain that sense of context and perspective. And I was talking with a member even just yesterday and talking about, how they're feeling in the markets and volatility and all those sorts of things that we hear on the news. And the feeling was, I don't feel anything. I feel very neutral about things. I'm just following the process. I'm just being consistent. I'm not listening to noise, but I do chuckle when I hear some of the noise and have people, putting their frame on the market. Why this has happened is they don't know why it's happened.
It's a good point. You get to a stage where people throw the universe throws stuff at you, right? Either through friends or family. People are talking to me about it all the time. Right? I go to the golf club and people talk to me about the market, right? But you read stuff. And when you can differentiate between noise and data information that you can act on, and you would have been inside that bubble where the noise would have affected you beforehand and got you to do something that you shouldn't do, then you get to a point where you can step outside. You see yourself being outside of that noise bubble, and you can immediately recognize it as noise, and your subconscious says to you, ignore it. I'm neutral. Doesn't matter. I've got this. My edge, my flow has got this. And you people listening will sit there and think about whether you're in the bubble or out the bubble. Are you an insider or an outsider of that noise bubble?
Yeah.
And just test yourself and see how you feel. Maybe put it into your trading plan as to where you are. Where am I relative to the noise bubble? Because the noise starts getting amplified in times like this, and individual variables get massively pumped up, and that's the noise. That's just what's going to happen in a market when in an environment where there's money at stake.
Yeah, that's a huge transformation. When members are starting to think like that, because they are outside the bubble. And again, this gets back to LTTP, the work of James Clear and Atomic Habits, the way that they now identify themselves compared to the way that they used to be as traders. I need to I'm a person who needs to have conviction and know the outcome of every trade, as opposed to somebody who remains calm and neutral and, without any expectation on any outcomes, understands the random nature of an edge, but understands how an edge manifests over the long period of time. It's a completely different way of thinking.
Absolutely. And when you can be aware of that, on self-reflection, you can measure your growth as a trader. Right, just wanted to quickly look here. The main thing, I put these statistics up, which you obviously can see in your portfolios, is that the maximum drawdown so far in the portfolio is 7%, index is 8.5, current drawdown 6.5 versus 7.25. And the point there is that we haven't yet reached the minimum threshold of 10% for the Learn to Trade Properly goal. We want to get that goal because the Arnie Schwarzenegger quote that I put up beforehand is that you only gain strength through struggle.
Yeah, and one of the members I know is very, very much into their sailing and gave the analogy of learning to sail, and used to be quite scared of sailing into the strong breezes and things like that. Well, how? If you think about it from that point of view, if you've gone out and you've sailed your way through a 30-knot breeze, the sense of achievement that you would have as opposed to sailing in a 22-knot breeze, that's the kind of feeling that we're looking to try and get. And that's why, whilst it is uncomfortable, we're learning to become comfortable being uncomfortable.
Yeah. And the skill of tacking.
Yeah, that's it.
The point here is that there've only been 6 trades in this so far. 5 have been losses, 1 winner, which is the one that's currently open, and the whole periods have been pretty short. They get cut. Lost trades get cut quicker, so they have shorter whole periods. So we just wanted to talk, give an example of not trading properly, because we talk a lot about trading properly and we focus on all the things that you should be doing. Here's an example of what we shouldn't be doing. And this is an LTTP attendee who has not done the 4-week training intensive, so didn't get the foundational theory, if you like, the Mark Douglas and the James Clear stuff going into it, and also didn't get the training on an edge, which is in session 2 and talks about research and long-term edge and expectancy and all that sort of thing. So I'll just read it to you. Hi, Jane. Apologies for the delay in addressing this matter. Unfortunately, I won't be continuing the subscription as I've not found it to be beneficial in giving me an edge in my trading. Only 1 out of the 6 trades taken was profitable, resulting in an overall 10% loss in my portfolio, which is not what I was expecting. Most of these trades I ordinarily would not have taken. I put the he said would have taken. I put the not in there. Should we go before the apostrophe VE, as they did not meet my normal trade entry parameters, but did so on the strength of the mechanical edge espoused in the course. Right, so a couple of points there. So a small sample, 6 trades, too much pain.
Oh, yeah, definitely.
Too much pain.
Yeah.
And this particular member has also spoken about the analysis. He's trying to pull the analysis of Sparse Investor apart, but doesn't know. So he's talking about an identifiable edge, right? Is what he spoke about in some of the emails leading up to it. So firstly, the overall 10% loss, well, that is actually a goal of the LTTP skills acquisition plan, is that we want to get to 10%. It's going to happen. We just don't know when. It could happen straight away, or it could happen a long time into the future, and not expecting. So, and we put a lot of effort into talking about anticipation, expectations, and we talk, this is not our material, this is James Clear's material, and also Mark Douglas's material about the neutral mindset. There's a random distribution in wins and losses of any given set of variables that define an edge. I do not need to know, going back one fundamental truth, I do not need to know what's going to happen next in order to make money in the market, right? So this is an example of not trading properly. So to ask you questions, what kind of edge does A need to accept all risks, be rational in his trading, objective, to trust his system, himself, and the market, and to achieve confidence, all in order to be consistent, to achieve consistency? What sort of edge do you think
that character
A would?
Oh, he needs a 100% guarantee that when he puts his money in the market that he's going to win. Otherwise, I don't think he's going to have any faith ever.
So 100% winners, but I know that he would say, I can't do that.
Yeah. Well, that's that's the logical mind saying, because we know you can't have 100% winners, but the primal mind doesn't think like that. It thinks, I can solve this problem. If I do more analysis, I'm going to get there. I'm going to solve this, and I'm going to spend, I don't care how long it takes, I'm going to do this.
So the primal mind being...
the ancestral mind, the fight or flight type of response. I've seen this before, so therefore I know what's going to happen. I've seen this trade. I know that this trade's going to be a loser because, look, it's in a big downtrend. I'm putting my expectation, I'm envisaging a particular outcome, and as a result of that, I'm going to say, no, I'm not going to take that particular action. So we're taking ourselves out of, for whatever reason, a whole lot of subjectivity, the fear of, not accepting risk.
So the threat of pain being the loss trade being the saber-toothed tiger.
Oh, 100%. Yeah. And every time we see that, there's the saber-toothed tiger.
I've got to avoid the saber-toothed tiger at twice the rate of the green veggies over there that I'm going to eat. Okay. So the point we want to make here is that and this is where people talk about searching looking for the holy grail, and it's just impossible to do. So you're not going to. So it's purposely put up the accept all risks. So this is the path to consistency: accept all risks, be objective, rational, and then trust in that objectivity, that rationality for your decision making, which then gives you confidence. So trust always becomes before confidence. So you'll never be confident. Confidence doesn't guarantee a positive outcome. What it does guarantee is, at a high enough level, is that you'll execute your process, your objective decision-making, rational decision-making process in which you trust. And all of that leads to consistency, which is the end game. And then from that flows, which these are all skills, every single one of these are skills, flows profitability at the level that you can achieve. Yeah. So can we identify as dysfunctional trading beliefs?
Well, if we think about, Mark Douglas and the 5 fundamental truths, which are the foundation of, of any successful trader, they think that not anything can happen, because through their analysis, they're really thinking, I'm going to be able to solve exactly what is going to happen.
Yep.
And so therefore, if I do that, I'm going to get the edge that I want.
Which is James Clear as well, isn't it? Because James Clear says for every unit of work or effort that you put in, we are programmed, primal brain, our subconscious brain, to expect a positive outcome. That's how we are. That's when we do something, we expect, we want, we desire a positive outcome. And when that doesn't happen to the degree in which it happens in the market, then that primal belief is dysfunctional with respect to trading. Probably with the other things in life too, right?
Yeah, that's right. Yeah. It's a great point. I was just thinking there, our brains are a reward mechanism. They're a reward seeking tool. So from that point of view, it's going to be very, very different. We have to think about a different type of reward when we're trading, don't we? So rather than being outcomes focused in terms of our rewards, we need to think more internally about becoming process focused and identity focused. And think, right, that's the sort of person that I want to become, because if I know that if I can become that type of person, then that's going to allow me to trade whatever edge I want to.
And Carl's got a little puppy that they've had for a week. So how do you train a puppy? Now, I'm not saying that we're all puppies, but the learning process is probably not that far. Is if you follow the process, you get a treat, and that treat is the decision of whether a treat happens or not, and you can do this, and psychologists, trading psychologists, other psychologists do this, is that you reward yourself in some way, not for the outcome, no matter what it is, you reward yourself for following the process. And then you count back how often you followed the process, pre-shot routine in your golf game, right? The process you went through and how many times you bounced the ball when you serve at tennis, whatever it is, and you count how many times you followed the process correctly rather than the outcome you got, because the outcome is random. There's a random distribution, right? And also anything can happen that can slush ball you from left field that is just your process is never going to be able to handle, ever, right? And those are the times that you have an outcome that you don't desire. So you have to reframe how you think about losing and how you think about what winning is.
Yeah.
Okay, so what other dysfunctional beliefs are there? Well, I can say that he is not expecting a random distribution of wins of losses. He's expecting there to be just wins. Yeah. So so that's fundamental truth number 3. What's fundamental truth number 2 is that I need to know what's going to happen next in order to make money. So he needs to know. He needs to go and find. So this is a dysfunctional belief. I need to go and find a set of analysis techniques or tools whereby I do know what's going to happen next in order to make money. Whereas, this whole, and Mark Douglas spends a lot of time talking about the skill of not knowing and surrendering and giving up. And so does James Clear talk about that as well, is that you don't need to know what's going to happen next to make money. So can you identify the dysfunctional trading? So yes. So the answer is that he is thinking the exact opposite to what the 5 fundamental truths are. Yeah. The exact opposite. And every time that you think in the opposite way to what the 5 fundamental truths are, that's not coming from your logical mind. That's coming from your primal mind. It's coming from who you are as a human being with respect to trading. And that is your current trading identity as determined by your current trading beliefs. And the task, sure, there's an analysis role. There's no doubt. The analysis is to establish an edge, no doubt about it. But no matter how good an edge you have, it's always going to have lost trades. And unless you de-energize the dysfunctional beliefs you have with respect to trading, you are never going to be able to trade properly. It just will not happen. So you have to go and change your trading identity.
Yeah. Otherwise, they're just going to be in a world of pain. They're going to feel the pain, and that's going to keep them in that sea of uncertainty.
Correct. Right. So let's just keep going. The USA, there's a really big, so we'll come back to trades. We're going to get into that straight after this. We're going to get into individual trades and talk a bit more about the indicator and the mechanical trades. The 3 trades we would define as stumbles there, no leaps at this stage, also 6 weeks old. This is the USA, and it's been one big one. Axon has delivered some really good, juicy profit trades over the last 2 or 3 years. and it had a really big fall in which generated an exit signal. And these can happen. In fact, I think the biggest losing trade to date, off the top of my head, between the two public portfolios, two lots of now 18 years of trades, if you like, between the two markets, is Netflix, which was a 33% loss. Happy to put that out there. Why? Because anything can happen. Anything can happen.
That's it. And for if you focus in on that, those losses, etc., you might find yourself thinking, oh, is this working or is it not working? But if you're objective and you open up your mind a little bit and think about, well, what's the flip side of this as well? I mean, some of the profits of Netflix and also Axon, as you mentioned,
correct,
have delivered fantastic profits following exactly the same process.
In fact, what we'll do, which we hadn't planned to do, is we'll go and have a look at the edge of Axon. We'll just call it up and we'll have a look and see what the expectancy of Axon is over a long period of time. Okay, and so where's that portfolio? It's slightly below the which is the environment. So that red line describing the environment that we've been in. 6 weeks has been a bit of drawdown. Sorry, let's just go back there. Maximum drawdown 9%. Index has hit 10.4%. Current 6 and 7, right? So the portfolio still hasn't reached that goal yet of 10% to trade through.
It's getting close, but and again, it's just one of those things we'll be able to say, when we get to that particular point, okay, how are we going? Are we, how are we going with the process? And importantly, how are we going with our mindset? What are we thinking on each and every trade that we place? The 25 trades exercise, I can show you examples from each one of these LTTPs that there's a journal entry for every single one, Gary.
Yeah.
And every member should be doing exactly the same.
So the goal is not to reach 10%. The goal is to trade through, reach the 10% and maybe lower, and then reach a new all-time high in the portfolio. That's the actual goal, right? Because that then is, according to Arnie's words, that's actually coming through the struggle. It's going into the struggle and coming out, and that's where the strength comes
surviving.
from.
So
correct.
That's sailing. We've got to our 30-knot breeze, but we've made it all the way safely back to shore.
Correct. And we've tacked our way out and come back. Just 11 trades there, 2 winners so far, 9 losses in total. Okay. Now, as a precursor to looking at the analysis, we did get this email. Do you want to read it, Dave? This is
Hi, David. Does any of this from an article from the Australian Financial Review today have any implications for SWS stocks and our signal? So it's a family query from a long-term member. I understand that research is always ongoing with regards to what stocks are included, but your Gary might like to comment. So this is from the Financial Review.
Oh, sorry, somehow I've missed the rest of the thing there. Let's just go into it. Didn't do that properly. Learn to do presentations properly. Delete. There's the delete key here.
There we go. So this is just a snippet from the newspaper. The juice has been squeezed from the Magnificent Seven, she argues. So this is the author of the article. And the big fiscal tailwind has been reversed. There are winners to be found amongst the other 493 companies in the S&P 500, but this will require hard work and careful selection. For example, the companies that can deploy AI to make their business more profitable are yet to emerge. I'm not too sure what she's thinking along this, but anyway, if there's one consolation, Tunkel says, it's that conditions are right for stock pickers to beat the passive strategies that have enjoyed such strong gains in the past few years. But to find these winners, investors are going to have to get their heads around tectonic shifts in the market consensus beliefs that free trade is good, that America was the sheriff of the Western world, that the US government could spend its way out of any trouble. Wow.
And happy to put Wakefield's name there because he's publicly been on forums and given public reviews and things like that. Yeah. Okay, so there's a few things going on here. The one is the anticipation of tapping into from an analysis point of view, the 493 stocks, obviously, which some we do in the universe, but potentially to expand the universe so as not to miss out. So there's a little bit of not wanting to miss out here. And I know, the Wakefield makes the point it's a family query because he's pretty happy with both US and Australia.
Yeah.
He's voiced that quite openly and has trust that the rest of the universe are going to go ahead. But obviously the family member hasn't had that training. So there's a little bit of fear of missing out, which is fine. And there's always room to improve and expand and look at doing that. I think the other point here is the amount of work involved in doing this.
Oh, wow. Just reading through there's a lot of work to get their heads around all these things, Gary. I mean, how would somebody do that?
Well, these days, how would you go about defining what an AR stock is and which isn't?
Yeah. And that's right. And being able to have the skills to be able to do that, the amount of time that
I mean, there are third parties doing that, but they don't get it right, so you'd need to check it, and there'd be all kinds of subjective perceptions on.
It's interesting, isn't it? Because all these people who might have the skill set to be able to do that, they might be working at Deutsche Bank or somewhere like that, and there might be another herd of analysts at Macquarie or whoever it might be, and they might have totally different opinions about because they're doing their assessment from different points or different frames of reference. And so even if they were in charge of multi-billion-dollar portfolios, some of them might be buying, and yet the guys down the road might be going, well, no, we think we're going to sell that. We've had that in our portfolio for a long time, and so on and so forth. So we get to see that on charts as price action, and we come back to the market is the world's biggest voting machine, isn't it?
Absolutely. And some other, let's just look at the words here, that can deploy AR to make their businesses more profitable are yet to emerge. So there's this, this big fear of missing out, that I want to anticipate, predict, be ahead of the game so I can, make big, juicy killers, one-off killers, And the other thing is that it's to deploy AR, not to be an AR creator, and not to be an AR, either a chip maker or a software provider or something like it. It's just to deploy it, which arguably will be every bloody business in the S&P 500 in time. But what they want to do is to get the ones early, right? And this is, where does this fit into? This fits into the fear of missing out. All of the stuff can come back to the four primary fears that Mark Douglas talks about, losing, being wrong, missing out, and leaving money on the table. And sure, but that doesn't mean that how would we go about this research? Certainly not fundamentally. We would go through just purely looking at trendability, volatility, and liquidity, and seeing that those are at high enough levels to meet the universe. And we want to have stocks having been around for enough time to have had up and down cycles in their price action of when the market, the voting machine, had a positive view and had a negative view on it, and then build the edge on that for that particular stock, and then include it in the universe, which we are due to do some of that, and we are ramping up to do that. And there's some may come out, but that doesn't mean that you're going to miss out with the existing universe that you have, as shown by the edge that we have.
Yeah.
So the other thing over here is that there are some other fundamentals, but to find these winners, investors are going to have to get their heads around the tectonic shifts in the market's consensus beliefs. The market's consensus beliefs, right? Whole big topic on its own. That free trade, that the share of the Western world and the US government could spend its way out of any trouble, right? So there are some concepts here which people will see as variables that are going to affect the future. Okay, and the degree to which you try and predict the future, is the degree to which you have dysfunctional beliefs with respect to trading. I mean, it's been proven over many years now, right? So we've got to sure be open, have an open mind, be neutral. There's always other stocks that can be added to the universe that meet the requirements, and that's on us. If there are any stocks out there that you think could meet sufficient volatility, trendability, and liquidity, and that have meet that over a 10-year period, then they're able to be researched, i.e. they weren't penny dreadfuls 8 years ago, and suddenly now are just shooting the lights out. Now, we need to have some hard-nosed data to be able to do the research on. Please put forward suggestions. I do that from time to time. So let's now, we'll go into beyond charts, and we're not going to go through all the portfolios. We're going to have a look at some specific trades, and I'm just going to clear the chart here to just get price action only. So this is that's Freeport McMoran. We need to, is it FCX or that's it.
Yep, Freeport McMoran.
So let's just look at the trading. We will actually look at some of the things. So these are support resistance zones, and just to clear the chart, we will get rid of some of them. We'll get rid of that one, and we'll get rid of this one as well. So there we have a trading zone. We have a downtrend. We have a profitable trade. So in this sideways moving market over here, sorry, we were in the wrong spot over here. In this, so we come down, and then we get into this sideways moving market, comes into the zone, stays in the zone, some winning and lost trades, and the consensus, if you like, in technical analysis is that you mustn't take these trades that are in the zone over here, because they will they'll give you lost trades, because you're in a sideways moving market. And you hear all the theory, it makes wonderful sense. Most things that make wonderful sense to simple logic, that you kind of grasp in 3 seconds, most of the time the opposite is true, right? Is that markets spend 30% of the time trending, either 30% that's up or down, and 70% of the time going sideways. And there is some truth to that, but it's universally can't be applied to every single situation. And it doesn't mean that in the 70% of sideways that every trade is going to be a lost trade either. But the most important thing is that the big trades come out of the zone, out of the sideways moving market. So for you to now subjectively pick which one of these is going to be the one that is going to do this, which I think was over 100% profit trade, it's impossible to do. Yeah. So to reject this, so if you had to now go and put, so there's the trend, okay? You could now go and put a moving average on here. So let's just remove all of this. So now we're talking technically, okay? So there's been some lost trades. That's probably a break-even trade, lost trade. That's a winner, lost trade, slight winner, lost trade. They were lost winner. So there's going to be a mixture of wins and losses in there. And in a sideways moving market like that, with the research I've done, is you're probably going to find the win rate drops to 25, 30%. Okay. But in a rising market, it hops up to, when the rising market for the stock, it rises to probably 65 to 80% winners in a rising trend. But the problem is that you're going to miss the winner that comes out of the sideways moving market if you ignore all of the trades that are in the sideways moving market. Yeah. So let's go to, I think I've got a, no, I don't. So we'll go to indicators, and we'll do moving average, and we'll do an exponential moving average, and we'll make that long term. So 30. And we'll apply that, and that should be 30 week, which is 150. 30 week is the one that people use, and you'll see that if you now, so if you have another indicator, you still would have taken some of these trends over here, but the general thing is that you don't take a trade, and this one you would have just missed, and you would have obviously got into it, but if it's mechanical, you would have had a much worse edge through this period of time by trading in and out of the 30-week. And we know that a 30-week moving average or a 30-day moving average in and out does not have an edge. It has, if it's an edge, it's a slight one. Expectancy wise, it's like 0.01 or 0.08 or 9 or 0.1 or thereabouts. Yeah.
And the other thing too with this, Gary, with your first part of your analysis, you had drawn on there, that downward trending set of the channel. So from a subjective point of view, your mind, your analysis might be saying, well, that's in a downward channel. how on earth could I possibly trade that? That's the type of belief,
Correct.
the type of expectation that we have, that anything's in a down channel is going to remain in a down, in a downward channel as well. So these are all obstacles for subjective technical analysis traders who don't have a system, a mechanized process, that they're going to have to try and deal with.
Correct. Work out which ones to get into and not. So let's talk about edge now, and I'll make the point here. This is what A was saying, is that he doesn't see an identifiable edge over a sample of 6 trades, right? And all of that information is here. So let's have a look at FCX over, and this is I think I've got my data setting at 25 years. I think over 25 years, right? If it has that much data, I think it does. So there were 42 trades, 54% were profitable, average profit trade 41%, average loss trade minus 11%. So that's quite volatile for they have a loss trade, average loss trade, average hold period there quite much shorter, 170 days versus 71 days, and a payoff ratio of 3.6. So you work out your expectancy, the combination of win rate and payoff ratio, and that gives an expectancy. Where we've got expectancy should be
1.55.
1.55. There it is. There 1.55. So I'd say anything over 0.4 is a decent enough edge to cover costs and to beat the index. Right. So if you got anything, and the higher the better, there's no doubt about it. But if you had traded this as a one stock portfolio and put in money. So the position size was the entire portfolio every time. So they started at 10K, got some profit, 12K, put all of the 12. So it is all to come on the next trade. You would have made annualized 18.29% compared to, do we see what the market does over here?
8.08.
8.08 over that same period of time. So you would have done 10 compounded percentage points better than the market. Now, you could do that if you wanted to. On that particular trade, it's volatile enough, etc., etc. So does Sparta Investor have an edge here? Sure, damn right it does. Okay, okay,
a very good edge.
Yeah, very good edge. And let's go and have a look at LRCX. So I think the dates we got here were December 2022, and we'll have a look. So a similar sort of thing. We're looking at this trade here coming out. There's the down. So we got out. There was a loss trade. So that's still in the range, if you like. It's in drawdown. Another entry signal. So based on this and any other, you put trend lines on there. You can put anything else, stochastics, RSIs, momentum. But the overall trend analysis of what the market's doing and what the stock is doing is this would be viewed as a bottom pick. Sure, it could be seen as a reversal, but then all of these were reversals as well, right? So which one of these reversals would you have taken on the way down? So analytically you could go and play around with all these indicators and all these indicators here to try and come up with an edge, but you don't need to do that because what is the edge on LRCX? This is again over 25 years. Win rate 53%, payoff ratio 5.6, expectancy 2.3. Right? So annualized return 16.6 versus what do we have? Also be roughly 8 as well. 11.68. That's because it doesn't have the full 25 year or as much data as FCX. So you're still outperforming. So does this have an edge? Yes, it has an edge, right? So when we talk about identifiable edge, and firstly, is this accepting all the risks in the market, this edge, by executing it? Sure, it's accepting every down period. It's accepting where all of that it's coming into it, right? Is it objective?
100%.
100% objective because it's mechanical. Can you trust it? Well, these are the numbers that give you the trust. The win rate and payoff ratio lead to the expectancy, and that's what tells you whether you have an edge or not. So is this edge guaranteed into the future?
No, it's not.
Absolutely. Nothing's guaranteed into the future. Right. Okay.
Yeah.
And we don't claim that. We never have. Yeah. And we always said the greatest drawdown you can have is ahead of you. But what we do know is that over a large sample, you have another term for edge is a probabilistic edge. So we are trading probabilities. You know, the 5 skills training course that we did, there's a section there on consistency where I absolutely pull this apart, right? And, you know, we talk about probabilities of 1. Is there a probability of 1 with trading? No. Is there a probability of 1 with any edge? No. So what kind of probability do we have? We have a probability that the expectancy tells us. And you know, if you take into consideration that anything can happen, you know, every moment in the market is unique, and that the future is totally unknown. That's the uncertainty principle that Mark Douglas talks about in Trading in the Zone, and it's totally unknown. Is we've got to surrender that we don't need to know. Is that the edge is going to be worse than that in the future, but that it's going to be good enough to be able to provide us a profit, warts and all, ups and downs, wins and losses, that is going to be better than if we just bought and hold an index ETF, particularly when the next secular bear market comes around and we have, you know, 50% plus full. So I mean, there are questions coming. I think did SPA3 pick up FCX or was the portfolio full? No, I think this was in the portfolio. This one, we did this trade. I think the LRCX one we did as well. Everybody's saying good. Not for the, okay. What is Bruce saying?
Bruce was just asking about registering this morning.
It's all good.
Pre-webinar one.
Okay, that's all good. So the point we want to make here. So how does this indicator work? I'll finish on that. I'll clear this chart. So effectively, this line here is got a whole bunch of things built into it. It's an adaptable indicator. I've gone through this before, but there'll be new members around. Is that the standard parameters for an ATR, it's called an ATR trailing stop, is that you have an up and a down parameter. So if we go into ATR trailing stop, and which is average true range, that's there. That's it there. Okay, and I'll make this nice and big. Okay, we can't do so. So the parameters here to put into it are it's a line chart. Then you got to have these two parameters: up multiplier and down multiplier, and then a smoothing, and then you work it out from there, right? So the up and down multiplier, if you use this indicator, and it's Wells Wilder, the book's over here, is that you determine where. So what I've done there, that's a 5-5. Let's just move this back. So this thin one here, I'll make it a different color, is we'll make it red. So the red one is a 5-5, right? And if you had to take this 5-5, so for instance, there is there's a sell signal there, then a buy signal over there. And you apply the multiplier 5-5 all the way through the stock, you'll probably have an edge, because it's a decent indicator. It's a trending indicator. But what you want to do, and you can see here we had a buy there and a sell there, whereas this had a sell there, a buy there, a sell there, a buy there, and a sell there. So there were 4 trades in that one that SPA3 Investor had. And you could go and play around, as I'm sure most of you know, with what the best multipliers are here, and you can make that a 7, and you could make that a 4, say, and then it'll change it, and then you can go through. Now look what it did over there. I didn't know it was going to do that. It actually made that one trade that period. There's the red line, and then you would go and look at each and every trade. You'd see what the win rate is. You'd see what the payoff ratio is. That is the average size of winners to average size of losers. You work out an expectancy. Okay, and that's what we do with this indicator, except what we do is we don't have one set of up and down multiplier. We have 7 up and down multipliers. And each of those 7 categories are determined by what we call a volatility level. Mm-hmm. And we have, so we have 14 multipliers, one set of up and down per volatility level. And then we apply those. And how do we work out what those are? By purely running research against the data for each stock. Yeah. And sure, it's intensive and all sorts of things. We've built tools around doing it. And then so we get a slightly better edge. So we have effectively in that indicator, which is one of Wells Wilder's adaptable indicators, so it adapts to volatility, is the ATR itself calculation has adaptability in for volatility. What we've done now is made 7 levels of adaptability for each stock.
Yeah.
Some of the more volatile stocks have 11 levels of volatility. Okay. And Amazon is one, for instance, that has 11 levels of volatility based on historically what it's done, and even now it has gets to pretty high levels of volatility. So that's what we've done. So we've got an adaptable indicator to determine when to buy, hold, and sell. And can it be improved? It probably could. Yeah. But how much more do you need to improve it to give an edge? Is SPA3 Investor the best edge in the world? High probability it's not, right? I've looked for those. I've joined courses and spoken to people. Is it good enough? It's definitely good enough. It's definitely good enough. I mean, that's demonstrated. It's proven historically. Is there 100% dead cert that it's always going to work in the future? I can't answer that. I can't say yes. And nor can you or anybody ever give that. That's a desire to want to know what's going to happen in the future. You can't do that in any field, right? And so we can't give you the guarantee, nor can you give it. Nor if anybody does give you that guarantee, well, I'd suggest you think about whatever. But that's how the indicator works, and it's not going to give 100% win trades. All the analytics show that over a large sample, over a large period of time, with costs involved, it's about a 45 to 50% win rate. Sometimes it goes up to 60, 65, 70%, and sometimes it drops down to 25% win rate, depending on what the market's doing. But what we can't do is say we're not going to take any trades in this downtrend, because when the trend changes, that's when you get the biggest winners, and that's where we get the trades like we got here. So those are the points that we want to make. Now, I know there'll be different views and different reactions to what we've just said, because everybody has a different set of beliefs. And they have personal beliefs and they have a set of universal beliefs. What we're trying to do, we can't teach you your personal beliefs. Those are yours that you use in various parts of your life. But what we do know through extensive research and other people's work like Mark Douglas is that there are also a set of universal beliefs, right? That comes from James Clear, that will work for everybody. And we can help you get those if you allow us to, and if you allow enough time and put enough effort in to do it. Because in our view, and in many other people's view, and you can go look on Amazon, Mark Douglas's book Trading in the Zone is still one of the most highly sought after and bought books. Just look at the ratings, even now, 25 years after it is written. And why? Because it damn well works, right? And it takes effort for you to firstly comprehend the information there. We know we've had, I know people that read it 10 times and not got it until they did the 4-week training intensive. And they said, wow, I didn't see any of that in the book, and you've made all the emphases, and now I get it, right? And after 15 years of rereading the book, they're now actually using it at a practical level to improve their trading. And that's what we can do. We can help you get the universal truth, but we can't do it in 6 trades. Okay, we just can't do it like A, right? It's impossible for anybody. In fact, I'd say that A is never going to get it if that's the way that he's going to go. I mean, you can't do that with a golf swing, a tennis swing. You're learning to type, whatever. You can't do it on a sample of 6, right? So, and not having done, the foundational training, the training intensive. So we're trying to use these portfolios in various ways to help you get it, for those that don't, and for those that do, to reinforce it. Because as coaches, it's one of the roles I think we need to do, is we need to keep reinforcing this, because when going gets tough, you're going to start questioning it, and then we have to reinforce it and show that it works. And we do that hopefully through we've been doing it through the public portfolios, but now we want to make it even more obvious and join more dots by doing it in these sessions. Okay, anything to add, because we've been going a long time today, Dave?
I was just thinking, it's a bit like the football games. This time last year, when the AFL started, Hawthorn had 5 losses in a row, and you would have thought at that point in time, well, there's a sample of 5 there. they're doomed. They're going to end up wooden spoon.
Correct. Yeah, you knew what was going to happen, because you're a Hawthorn supporter, so you were living.
So obviously their edge wasn't working, Gary, and it was never ever going to work
forever.
And yet they followed the process, and I mean that's just an example, I suppose. It doesn't relate necessarily to the trading world, but sample sizes do matter.
Absolutely.
And the whole point of Learn to Trade Properly is that we are putting ourselves in the game with a low risk, we're creating our own level of pressure that's suitable for our current skill set. And there's a really great snippet in the Learn to Trade Properly digest about SWAT teams and paintball, etc., and how they create the environment to be able to train in. And that's what we're doing in LTTP. So I think it's really important to recognize that, allow ourselves to develop these skills.
Absolutely. So hopefully that's been helpful. If there's anything that's any questions that you have arising out of the session, send them in to us. We'll answer them. Any suggestions, we'll take those on board as well. But hopefully it's been a beneficial session for you. And as always, we wish you consistent, objective, and peaceful trading.